So most people, I think, underestimate the power of compounding. We always hear time in the market beats time in the market, but let me show you what this means as an actual dividend investor. Now, if you did this correctly and consistently and reinvested your dividends without disturbing the snowball, after 15, 20, 25, 30 years, your portfolio will start paying you a salary. And the best part of it, that is still income. And if you set it up correctly, tax-free if you're in a stocks and shares ISA in the UK. So let's get into it in more detail. Let's go through some model portfolios and also what yield on cost means, what it means for you if you prefer growth or even dividends or a mixture of both like myself. And if you like this sort of stuff, leave a like and comment what you have in your portfolio. I would be interested to know actually. So let me explain what the dividend kind of snowball is without going too crazy. You need to start off small, building a habit, investing in solid companies that do, or maybe not, even essentially pay a big dividend, but have a growing dividend. But the main nucleus of this is building a habit of a solid company. Simple as that. Those dividend repayments, whether it is twice a year, whether it's yearly, whether it's quarterly, will have to be reinvested back into your investment portfolio. That then allows you to buy more shares with the income generated. So it's not really affecting your ISA allocation if you're using an ISA or your own capital. Now, more shares equals bigger dividends because you have paid per share. So how many shares is worth X amount, you get paid the dividend based off that. So if you have 1,000 versus 100, you're going to get paid a lot more if you've got 1,000, obviously. And the cycle then repeats every single year. So 1 year you may get, say, £200 dividend payment, and in 10 years' time, that £200 will be a lot more, which is where the yield on cost comes in on it. Say if you buy a stock today at 4% yield and that company keeps growing its dividend by 5, 6, 7, 8% every single year on, base of performance alone, that isn't value appreciation, by the way. I think people get confused. So say, for example, if something pays you, say, 15p per share, it may well then be 17p the next year and then 20 odd p or what. You get the idea, right? It just goes up. Now, in 15 years' time, if that continues, you are not earning that 4% yield anymore. It might be between 10 and 15%, depending on what that actual thing is, based off the original investment. And I'm going to show you a really solid example of why that is important if you look at Warren Buffett. So this is my portfolio here. We're going to go through a little simulation of two portfolios. We're going to build our own from our own portfolio. And we're also going to showcase another one, and I'm going to showcase as well why Warren Buffett gives you the perfect analogy of this in terms of what he has done. Now, on the passive income on my own portfolio, I have a 2.61% yield off my individual dividend stocks. This does not include my full world market fund, which is the Vanguard All World one, right? So I have a dividend growth of 6.48%. And I do have contributions added. So it's important to note in your simulation how much you're reinvesting. If you are reinvesting the dividends, your growth and the yield. Okay. So with that, you can get a rough sort of number. But as I say, with my portfolio, a little bit of a caveat to this is I have the all market fund. That is an accumulation fund. So whenever dividends are paid, it's directly into that fund. That will compound in value. If that starts getting a bit crazy in terms of growth value, I can reinvest those by pressing the rebalance button and putting them into the dividend stocks, therefore making it snowball still, technically, in terms of going from growth into income. We'll come on to that later on. Now, as you can see, over a year period, into year 1 to year 2, from this current value, it's going to grow a little bit. Likewise with this bit, and this bit, and this bit, and this is passive income based off the reinvestment of this portfolio. Now, if I do change the parameters of this, I can, you can press like the more button and you can start seeing more and more stuff, and I can change these if I need to, but I don't want to do that just yet. Now, with that in said, when I mention the word 10 years down the line, you start noticing it's around 5-figure payout. When you are contributing 20 grand per year in terms of your ISA, for if you're in the UK, if that's still available at that point, you are going to get more and more growth quicker because you can reinvest an extra 10 grand on top of it through income. Important, right? Likewise, if we go to the 20-year point, which is we're roughly looking at 2039, give or take, 18,000. Look at the speed in which you've grown 8,000 versus the first 8,000. The compound gets faster and faster and faster. Likewise, if you go into 2044, which is give or take in and around 20 years from now, it's 32. You can see how aggressively and how quickly this goes. And that is essentially telling us where we're going to go in this situation. Now, if I add some extra value to this, say 50,000 randomly, right? We will get more data. And therefore, when you start seeing it in terms of 2049, it's pretty crazy to think from that time period, within 4 years, you are going to make a nearly 20,000. It grows aggressively. Now, a very, very quick model portfolio. If you're using ChatGPT, you can figure this out as well. And realistically, it's pretty crazy. But even after 15 years, annually, on that alone, £500 a month, 13,000 dividends, which is crazy. But the magic, as you can see here, is in between this gap here. 5 years, it is pretty much a lot higher. That's where the magic is. And another 5 years, even more. So just to kind of give you an idea, that's why it's important. And I know people in the comments will be like, well, it doesn't really always work, but no, it doesn't. However, solid companies, decent-ish growth on the yield, and more importantly, the yield itself is going to pay if you continue doing it. And that's the thing, like, it doesn't just grow, it accelerates, doesn't it? It reinvests, and leaving it alone is so powerful. The first 10 years feel slow, and they are slow, and I'm in that period myself. But between 20 and 25 years, the compounding really takes off. And let me showcase an example, which is what I mentioned before, with Warren Buffett. This is a Warren Buffett example. It's absolutely bonkers, this, by the way. So in 1988, he invested 1.3 billion into 400 million shares of Coca-Cola, which I know is mental. No one has that sort of number. But what I want to kind of prove to you is how crazy it is in terms of yield on cost. The shares at that point is $0.075, meaning they will receive 30 million per year in dividends, which in real terms, not a lot considering your outlay is 1.3 billion at the time, okay? But today, that now pays $1.94 per share. With 400 shares, rough numbers, it collects 776 million every single year in dividends. That is just showcasing how that yield on cost has changed dramatically. It's actually 60%, that yield on cost, versus that original investment, which is crazy. So imagine buying shares 20, 25 years ago. They are still solid companies, and whether those dividends are, you're making a hell of a lot of money. Now, not every example will be like this, but you get the idea. Even if you can narrowly put up your yield on cost from 4% to say even 12% in a decade or two, it's going to just pay you pretty quickly. Now, I know you probably worked this bit out, but this is why dividend investors like to hold for the long term. It's a different tactic. And I know people will always be in the comments with me going, oh, but what about growth? Well, I'll come on to that. But yield on cost, just to go over it a little bit more. As I say, the longer you hold, the better the maths work in your favor if you're picking a growth stock. Now, for a lot of people, the yields are quite small and those increments are little. So if you put, say, £10,000, okay, into a 4% yielding stock, that's £400 a year, obviously, right? Quick, simple maths, and even I can do that. But that dividend, say, grows, say 6-7% in the last 20 odd years. That original holding, even though you're reinvesting, is paying you $1,550 instead of that $400. So that yield on cost is going to matter. And as I say, when we talk about longer term holdings, great. And some people will always argue that, yeah, you don't get much appreciation on dividend stocks, but they are a lot less volatile. So it makes it a little bit easier. But overall, providing your income is returning. And as I say, I've got another £10,000 I can put into this portfolio. That will go and increase this annually. Next year, it will go even higher. The following year, it will go even higher. So when you're following me on this channel, on this journey on my own portfolio, which you should be subscribing, we will be, hopefully in 7 years' time from now, in the 5-figure sums. By the way, if you're interested, this tool is in the link below. There's going to be a nice juicy discount, but you can get a free trial. You get nice little discounts on there. It's an amazing tool. You can do your research on there as well. Never mind just the obvious in the room, which is, yeah, you can see. You get everything. So on Stockopedia, what I've done here, we're going to talk about dividend growth versus growth stocks, just to give you a bit of an idea, right? Because I personally think it's probably good if you're young to do growth, but also you can also do both. And I'm going to explain with my own portfolio why this is important. So obviously growth stocks will give you appreciation and value. Dividend growth will give you that appreciation over time, slower, but also the growing income stream, which becomes pretty impossible to kind of gauge. But more importantly, the key is not to underestimate how powerful dividends over time will be. Yes, there'll be recessions. Yes, there'll be issues, But more importantly, if you start in your 20s, 30s, or even 40s, you can still snowball in time for an earlier retirement where you can ease back a little bit, right? Now, on the screen, on Stockopedia here, there's a link below to this platform if you're interested as well with discount. I've put the CAGR for the dividend payout essentially to go up per year. I put a dividend streak of 5 years and a quality rank on this platform of over 80. So the quality companies, right? These are companies that have been paying out money. Their growth over the course of the time will compound those investments pretty nicely. You got some really obvious ones, such as Papa John's. You've got all kinds of stuff in here that you can look at and go, this is pretty decent, this. Wherever side of the Atlantic you're on, right? Now, the situation is there's plenty of companies you can choose here that will fit the profile of dividend growth investing. But as I say, not everyone likes it. So, for example, with this one here, Associated British Foods, right? Just to give you an idea, in terms of like overall metrics on price, not amazing. But what it will give you is dividends. What it will give you is a solid company that is probably not going to vanish at any point in time. Now, that's the situation that you got to kind of look at. Where do you get paid? Look at the growth in the dividends. Absolutely astronomical. As I say, if you were invested in this in like 2010 onwards, you are tickle pink right now. There's a lot of companies like that. But ultimately, when you talk about that in terms of the real sense of the value of the asset, if we look at the last however long, the price hasn't gone up loads, has it? Now, that's where people get a bit upset about dividends, and I understand why. But this is why I say to people, do a mixture of both, because you can have both sides of the spectrum. Whereas with my own portfolio, as you know, now I've changed it and I've now got the all world in there, which is 40%. So 40% of it is for growth. The rest of it is for essentially dividend stocks, which if the appreciation goes up, it goes up. If it doesn't, it doesn't. Some of them doing all right, some of them are not. But realistically, they are paying me. But as I said at the start of this video, I will be looking to move this over if it gets overweight, not changing the allocation, just if this goes to like 45% because I'm getting dividends, it's compound, it's growing, outperforming the other stocks, I can just press the rebalance button and guess what it's going to do? It's going to put that money surplus into all the other stuff and then I will increase my income stream. That's the only way I'm doing it, and I don't think it's anything radical. I just think it's common sense. But it's good to have both because at least then you can kind of marry them up essentially because yes, some of the ETFs are good, but also some of the stocks are good too. Some of them are not amazing, but some of them are good. They will go up and down in cyclical periods. It's just the way it is. But the one thing that is very, very, very important, and the only rules that you should be following realistically is don't sell when the market crashes. Do not disturb the snowball. Don't take dividends out and spend them in the early years. Simple as that. And always reinvest everything. Let it do the heavy lifting for you. That's the most important thing. And if you stop the compounding too soon, you may never see the growth phase. Now, for me, as I say, if you follow my channel before, you'll know that I'm a cryptocurrency investor, hence why the Bitcoin thing's behind me, the white paper. I don't really have to be heavy caked in growth. I can focus a lot more on that 60%, which is essentially going to be, at my age of 34, reinvesting to grow that income stream. I can always put money from Bitcoin or profit into, or whatever profit into crypto, essentially into this, and allow it to grow and grow and grow. That's the situation I find myself in. I've set myself up for tax efficiency with the stocks and shares ISA. If you are interested, by the way, Trading 212, there's a link below if you want to get some free shares or create an account on there because they have the best ETFs and they have, in my viewpoint, the vast amount of options for getting these dividend stocks. If you are doing your research, nothing worse than doing research and you can't buy them on a platform. That sucks. So, in 25 years' time, hopefully my portfolio isn't just an investment, it's a money-making machine. Of that, 60% of them as individual dividend stocks in the UK, which are the reason being why they're also in the UK is because of the tax side of it. I won't pay as much withholding tax. Even though I have the Vanguard All World Fund, there may be a little bit of withholding tax there, but nothing crazy. That's only applied on dividends, whereas if you're buying American stocks, obviously that's going to be a problem. So I am documenting my own journey for people to see, but I thought I'd explain the reasons why the snowball is so powerful and why you should probably look at growth and dividends at the same time. Doesn't matter how old you are, you've got to get that income going at some point. It will take time, it will be slow, but obviously have the growth side of it, it will help you. So there's no real big bias here. But ultimately, as I say, the main thing is do both.